Hey, how's it going, everyone? In this video, we will be exploring what kind of dividend stocks I prefer right now, and then as a follow-on quest, I'll answer what kind of stocks I'll prefer later on in life. So to answer this question, it really depends on your retirement age, timeline, earning power, and whether you use a bidet or your sock to wipe. Basically, what I'm trying to say is that it can be boiled down to two options. So in a general sense, I have investing portfolios broken down into two categories. The strategy is really different depending on which category you fall into. The accumulation phase, this is where you're about 18 years old all the way up to about 59 to maybe like 65. This is your working years. In the accumulation phase, you are gathering your resources and trying to grow your portfolio. Now in the retirement phase, you're trying to preserve your wealth as much as possible so that it can last and so that you can spend money from your portfolio to pay for the bills, expenses, and to do whatever you're doing as an old man. And when you are in this phase, you better ask for the senior citizen discount whenever you go out to eat, you old dinosaur. And I got you, we're going to talk about both of these phases. So for me, I'm in my mid-30s, so I've got some time till retirement. So based on the definitions that we just learned, I'm in the accumulation phase of my portfolio quest, which means I'm trying to grow my portfolio to be as big as possible right now while I'm a young, strong man. But I work part-time at a minimum wage job, so I have time as wind to my sails, but my earning power is my major headwind. Luckily, I live in a dual income household, so I don't have to sell pictures of my sweaty nipples on OnlyFans to pay for the rent. Instead, I sell videos of my funky looking belly button. I'm just kidding. If you're into belly buttons, then no one's judging you. But according to this data, based on my income alone, I would not be living in comfort in any of the US states. Dare I say, even West Virginia. My goodness, have you ever been to West Virginia? With that said, because I won't be able to contribute as much money into my portfolio, it is that much more important that I allow my money to work for me through my investments. So the name of the game is how many days can I go without taking a dump? Which, funny story, for me, in my adulthood, the record is 7.5 days, which is a true story that happened during my initial military training. All of that stress and humidity just made going number 2 non-existent. I didn't even know that I could hold on to my poop for that long. But jokes aside, if I'm making $15 an hour, I want to be able to maximize the earning potential from the investments I'm able to buy. And the type of investments I like right now are dividend compounders with cheese. Shout out to the channel. So what are dividend compounders? They are companies that have an economic moat in their business or product. They have beautiful free cash flow and a track record of increasing their dividend payments. I look at other metrics as well. So for me, increasing top line and bottom line year over year, that's a given. But anyways, I call them dividend compounders because every handful of years through their stock growth and dividend payments, my initial investment in them will have compounded. So for instance, if I have $100 invested, that would turn into $200 with time in the market in X amount of years. Does that make sense? And before I lose you, when I say companies, I'm referring to their stocks as well. The reason why I say buying into companies is because I think of this investing thing as buying into a real business operation instead of just looking at them as stocks. And it helps me cope with the fact that at my age and my credentials, I'm a loser in terms of my salary. So if I get to tell family members I'm a business owner, I sound cooler than I actually am. Alright, so let's elaborate on dividend compounders. Full disclosure up front, before you take me out to dinner, I am a shareholder of all of these companies. And in fact, as of right now, filming this in just my underwear, I would say that these are my most favorite dividend paying stocks. If they go on a dip, I'm buying. If they tell me to grow a unibrow, I'll do it. So left to right, we got Hershey, Visa, Apple, Google, Domino's Pizza, and Texas Roadhouse. So hypothetically, if I were to have an accumulation phase dividend portfolio, it would look something like this. But is this actually a good dividend portfolio? Well, check this out. Here are my favorite dividend compounders up against the S&P 500 for the same time period, which is the past 10 years. So the teal middle, which is the line graph that you see below this dark blue graph, that's the S&P 500, referred to as the market. Collectively, with those portfolio allocations that I just went over, look how they performed up against the market. And let me show you a little more detailed slide. So here's the data and numbers from that accumulation phase portfolio up against the S&P 500. And remember, Jacob, this is only for the past 10 years. So with $10,000 invested into that portfolio on the left versus VU, which is the S&P 500, and reinvesting any of those dividends to buy more shares, the accumulation phase portfolio would have given you $60,000 from your initial $10,000. Whereas the S&P 500, it went from $10,000 to $30,000, which is pretty good. And when we look at it year over year, the performance, the CAGR, the annual rate of return, for my favorite dividend compounders, that would be just shy of 21% a year. Whereas with the S&P 500, you would have seen your money grow 12.5% year over year, which is still good and respectable, but 21%? So the overall dividend yield for these companies, it's not going to be juicy or cute, right? So when we look at Google, their dividend yield is 0.45%. It's less than 1%. Let's see who else is less than 1%. Apple at 0.48%, Visa at 0.76%. You get the picture. So what I am prioritizing right now is the dividend growth rate and the total return potential in lieu of a high dividend yield. So when we look at Visa's dividend growth rate, how much they're growing this year over year, 15%. Google's is 12%. Apple's is 5.5%. Domino's is 15%. Texas Roadhouse has been growing their dividend for the past 3 years at an average rate of 82%. And for Hershey, it's 12%. So to recap, in the accumulation phase, my strategy is to grow the portfolio valuation as much as possible by investing into dividend compounders, companies where their finances are sound and cash flow is solid. And speaking of solid, make sure you get your daily fiber amount, because doing a workout session on the toilet, pushing a Chipotle burrito out at 7 a.m. in the morning is not my kind of fun, especially when you're already running late for work. So take my advice and get your daily fiber amount. So let's fast forward through my working years. So let's say that my retirement portfolio number is $1 million, which is when I can just quit my job and be a grumpy old man that tends to his garden all day. About a year or two from pressing the retirement button, I would gradually sell the positions in the dividend growth portfolio and make a slow transition into becoming a retirement income portfolio. Not all at once, because I want favorable prices, so I would make slow acquisitions over the span of 700 days or so. So if I am a year or two out from hitting my retirement portfolio valuation, and let's say Visa is trading at an all-time high, a 52-week high, then I would sell out of that. And if Apple is trading at a 52-week high, then I would sell out of that as well, and then slowly make the transition to buying income-oriented investments. So for my retirement portfolio, I would fancy income-oriented dividend companies and ETFs, stocks that are focused on providing cash flow to me, the old retired guy. An income that's sustainable by its own strategy and method, whether it's distributing its high cash flow as dividends or profits from covered calls.
Excuse me, sir, I think you're yapping way too much. Can you just tell us which companies?
Which companies, you ask? Well, hypothetically, if I was retired right now, these investments would make up my income portfolio. I'm talking about JetQ, ARK, Altria, and Main Street Capital. And this is how I would break it down based on my risk profile and how I want that income to be broken down. So let's say my retirement portfolio is valued at about $1 million from selling out of those dividend compounders. Well, this is how I would break it down and allocate to these income-oriented investments. And unlike those dividend compounders, just check out the dividend yield. JetQ is sitting at 9.2%, ARK is 8.9%, Altria, the tobacco company, is 8.5%, Main Street Capital is 8.4%, but look at the difference. Their dividend growth rate year over year on average, very small, single digit and less than 5%. But we don't want to talk about and focus on the negatives, right? So the average dividend yield for this portfolio is going to be 8.9%. And the weighted dividend growth rate is 1.5%, which is a little less than the rate of inflation year over year. But check this out. We don't want to highlight the negatives. We want to just focus on the positives. So the annual dividend payout would be $89,000 with $1 million invested into these investments. And when we look at it month to month, that's roughly $7,500. Now, to address your concerns and talk about the negatives, when I'm 73 or even 81, I'm not going to care if my portfolio valuation grows or not. I'm going to be focused on the dividend income because I'm going to need that dividend and income to pay for my Chinese takeout, golf lessons, and other retirement activities. So to sum it up, in the retirement portfolio, the name of the game is having a high dividend yield that is sustainable and healthy. So high yield, low fade. What do I mean by low fade? Well, I'm glad you asked. So between you and me, I have this masculine urge to buzz my head. It happens every single summer. So right now, my hair actually looks like John Wick, which you see on the right side of your screen. So both of these pictures are actually of Keanu Reeves, one with a buzz cut and the other with long hair. I would say this is a close representation of what my hair looks like right now. So funny enough, if you were to put a suit on me and planted me right outside of Wall Street in New York City, I would fit right into the crowd. I look the part. And you might think that having long hair is cool, and it is, but there's a buttload of maintenance happening behind the scenes so that my hair does not look greasy or oily or flat. You know what? Let's go ahead and make a deal. I'll tell you what, if this video gets over 200 likes within 7 days of being uploaded, I will buzz my hair with a low fade. Scout's honor, I'll do it. 200 likes. But to get back on topic, for some people, they might see my hypothetical retirement portfolio and say that it's way too aggressive. But to me, it seems coherent. I mean, yeah, the dividend yield is a little high, so maybe I should throw in SCHD for that dividend growth rate. But for the most part, if I was 81 years old, I would be pretty happy with that portfolio. And to just throw this out there, in retirement, I would play it safe and only gravitate towards good, reliable choices with a proven record of sustaining their high dividend. Nothing sketchy. If it sounds fishy, like your ex-boyfriend's butthole, no matter how good it sounds or smells, I'll skip it. Because I'm telling you right now, as a young man, if my risk profile, what you see on your screen right now, is already low, then I have a pretty good feeling that as an old man, my risk profile is not going to skew to the right side of your screen and be a gambling crazy guy. So let me know what you think. This is my public sanity check. Does my plan look good? The accumulation phase and the retirement phase, those are actually my strategies right now. My actual retirement number is not $1 million like the example that I gave in the video. My retirement portfolio valuation number is actually $800,000. And as you might correctly guess, I am nowhere near that number. But we are making progress, and that's what matters. I am making the correct steps, no matter how small, towards that number. And before you swipe away so you can continue watching that half-naked person eating their mukbang, hear me out. Here are some quick little updates. So the channel went through a rebrand, right? It went from a block of cheese to being the mascot to now an actual cheeseburger. And I stopped using our signature orange color, and now I'm embracing navy blue. And not only that, once we as a community hit 5,000 subscribers, I'm going to work on the life story video and upload it then. And believe me when I tell you, it's a wild tale. And the last announcement, when we reach 10,000 subscribers, I'm going to do a full portfolio reveal and do a weekly recap of my moves. We don't have the subscriber count yet, but just like my dividend portfolio that I'm contributing towards with a minimum wage budget, we're growing and we're compounding. It's only a matter of time. So with that said, I'm going to talk to you next time. Stay safe and I love you.
God bless America. Woo!